The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Thursday, the 15th of May. Welcome back, Jeremy. Good to see you.
Hi, Gareth. Good to be here.
So it's been yet another very interesting week. Why don't you kick off, give us a couple of comments on what you think's been going on at the macro level that we should be aware of?
Well, we began the week with news that the US and China had agreed the basis of a way to negotiate some tariff settlements in Geneva at the weekend, which was great news for the market and also great news for those of us who, after Donald told us to last Thursday, we took his advice and rushed out and bought the US market because the NASDAQ has been up about 6% this week. So thank you, Donald.
To be fair, we passed that on to our listeners. So
indeed,
if they took that message seriously, they'd have done well.
Although, of course, we never give financial advice. But
no.
But I can't help really thinking that something isn't quite right in all this, in that it was only a week ago that the US did this deal with the UK, and then over the weekend they pull a deal out of the hat with China after what seemed to be the briefest of meetings. You kind of might ask the question here, how's this possible? And I think it's mainly because these are not really agreements at all, but just sort of frameworks for a wider discussion at a later date. You know, it's not a coincidence that the timetable is always 90 days. The main reason it's 90 days is that is about the time it takes for a product to leave a factory in China and arrive on the shelves in Walmart. So this type of deal keeps the boats moving. So while it's important for the media and the commentators around what's going on in the world to understand that the trade deals can be done, and they've started to do this, I think it's important to consider what the underlying damage that has been done to trust and the financial system while we've gone through this amazingly volatile period. It was very interesting what the Ruffer Investment Company said in their monthly update today about their take on what happened in April. Basically, they said it was the most volatile month for US equities since 1928.
Okay.
But we only saw the S&P close down 0.7% for the month. And you could look at that and say, oh, well, not much happened in April. But, as they said, these are really market dynamics that one typically would associate with an emerging market, not the issuer of the global primary reserve asset. And, the idea that everything is all right again and the US stock market is broadly round tripped for the month doesn't really tell the picture. The dollar's down 5% and gold is up 5% over the month. And as they put it, when the good news is tariffs on China are only 50 to 65%, and Trump has not sacked the most powerful central banker in the world, a portfolio focused on protection and non-US assets looks eminently sensible. Now, Ruffer would say that, but I think their point is valid that it's very difficult to put this sort of trust genie back in the bottle. And it is worth bearing in mind that for every bit of talk around trade deficits and trade imbalances has a capital account equivalent because we have freely moving exchange rates. And that means that for every trade deficit, there is a counterbalancing capital flow. So while the trade war, we can announce a ceasefire and we can even negotiate a full settlement, there is a lurking question as whether we can put the capital war to bed. But basically, Donald hasn't been hanging around. He's been doing trade deals and then headed off to Saudi Arabia for his first overseas visit since he's been reinstalled as president. And of course, it wasn't a coincidence that he chose Riyadh as his first destination because, as we've discussed before, he had a little debt to repay to MBS, given that he had obliged Donald and Scott Bessent by collapsing the oil price conveniently to coincide with Liberation Day back in early April. So while Trump helpfully did not put any tariffs on oil or gas or oil products, and the Middle East was pretty well left off the hook from a tariff perspective, he still felt obliged to pay Saudi Arabia a visit, and he did so in style. And that debt has basically been paid in weapons and special access to NVIDIA and other AI chips. So big Boeing orders, $140 billion of defense contracts negotiated. So deal done. And of course, this is an aspect within the Trump administration, I would argue, is not without controversy, because Saudi Arabia, while a loyal US ally, the biggest customer for its oil these days is China. So dealing with Saudi Arabia in this way will not have gone unnoticed. And I think why AI chips? Well, obviously, everyone wants to get their hands on AI chips, but a lot of these AI chips will be going into data centers, which are going to be built around the obvious sources of energy that the Middle East has. So I think as a sort of regional player, this is all part of this sort of burgeoning, emerging market economy in the likes of Saudi Arabia, the UAE, where they are trying to diversify their economies away from purely relying just on fossil fuels.
Okay. So they're keeping the oil price low, which helps Donald both domestically and in his battle to try and bring Putin to the negotiating table in Ukraine. And in return, he's peppering them with gifts and toys and US goodies, which they'd struggle to get in other ways.
Absolutely. Yeah.
Yeah. Okay. Yeah.
And in return, he collected a few trinkets as well.
He did. That's right. Yes. Yeah. So what else has he been up to? I mean, he had these trade deals. Was there much else going on in Trump's world this week?
Well, yeah, when you're the king of the world, you've got a busy schedule. And so, yeah, I think before he set off, I think he orchestrated the ceasefire between India and Pakistan. So he averted nuclear conflict in Asia, which just one of those things you do in a spare hour or two when you have. But he also, before he set off to the Middle East, he had time to sign a few executive orders which basically fired a broadside at the pharmaceutical industry. And I think this does have implications, in particular the cost of drugs in the US. And as this is playing out, United Health, which is the largest US health insurer, is in somewhat of a tailspin. This week it lost its British CEO, Andrew Whitty, who used to run Glaxo, unexpectedly. And this is after losing, tragically, a divisional CEO a few months ago in an assassination. And this week it's been revealed that United Health is being charged on counts of defrauding the US Medicaid budget. So the shares of this company are now down 60% in the last month. So this whole story, I think, has legs, and I think there will be secondary effects here.
Some ramifications for the UK, yeah. See what happens to our drug prices if Donald brings down those in the States. So, yeah, okay. And what else has been going on? Anything else more broadly that we should be thinking about?
I mean, the US had a bit of a boost with lower than expected inflation. The general surveying and the betting markets are suggesting that most global investors are stepping back from the sort of high levels of probability that we'll get a US recession this year. The polymarket betting odds suggest that the likelihood for a US recession in 2025 has fallen from over 60% a few weeks ago to under 50% now, and that we're coming back to this idea of a softer landing, but that's obviously still contentious. And the bull market, or the recovering market for risk assets on the back of the US-China trade deal, petered out yesterday amidst a strengthening dollar and this stubbornly high long bond yield that we've got everywhere, but particularly in the US.
Okay.
And in the UK, we've had a tick up in unemployment from 4.4% to 4.5%, but wage growth running at 5.5%, so still seeing real wage growth. We had Q1 GDP figures in the UK, which were well ahead of expectations, running at 0.7%. So Rachel Reeves was on the radio today saying we're the top of the G7 for economic performance. So she'll get that in while she can. But who knows? Maybe it will last. But yeah, we've still got to see the full impact of her budget yet.
Yeah.
And what does this mean for the market? Well, probably not a lot directly, but as we've been saying every week for the last few weeks now, the UK market does have a better feel to it. In the last month, the FTSE 250 is up over 10%, the AIM market's up by a bit more, and there are signs of life in primary market activity. So, yeah, I think there's evidence that the great rotation that we've talked about, the move away from US assets, is having some beneficial impact on the UK.
Yeah, no, I think that's right. Talking to companies and investors, everyone seems to be just that little bit more positive in the last few weeks. So yeah, fingers crossed, hope that will carry on.
So what have you been looking at?
So yeah, looking at some of those companies and what they've been saying to the markets, there's been a very busy week actually. I'll rattle through some of the progressive clients that have had news. We had a small acquisition from iDocs, which is the provider of local authority software platforms. They made a small bolt-on deal, which seemed a pretty good fit with the business. Gamma Communications, they had an AGM update. They're talking about a strong start to the year in Europe, but the UK had been a bit soft. So it's quite a reversal of the last few years where the UK has been absolutely motoring and Europe's been a bit difficult for them. Those two have switched around, but that wasn't particularly well taken by investors, so the shares are off a bit this week. But hopefully they can get the UK back on track and continue the strong growth they're seeing, in particular in Germany. Then we had Virtue Motors, the car dealership. They announced FY25 results for the year to February. They were in line with the previous trading update and guidance that had been out there, and that they talked about a good start to the current year. And obviously March is a very important month in the vehicle selling calendar, so I hope that's a good sign for their financial year overall. Then we also had some H1 results from Nexus Infrastructure, which is a relatively small civil engineering and infrastructure business for the house building space. And they talked about the house building recovery. I mean, a lot of the building construction groups have been talking in pretty strong terms about the opportunities around the Labour government house building plans. And Nexus said, yes, they are seeing that. They mentioned that the house building growth trajectory wasn't perhaps quite as steep or as strong as the market had been hoping previously. But at that slightly lower rate of growth, they felt there was relatively little risk of pinch points or capacity constraints sort of disrupting things. So it might be slightly slower growing, but at least it's more reliable. So that was quite interesting to hear from Nexus. And then finally, we had Secure Trust Bank, who gave us a Q1 trading update this morning. It's a specialist lender and now also a retail deposit taker. They said they'd had a pretty good start to the year. For Q1, they had year-on-year growth of 10.5%. and then net loans, and they've got costs quite nicely under control. So again, good to hear that they've started the year well. And I think that news overall from that group is consistent with what we're saying, that most UK companies, they've dealt with or they're dealing with the difficult market conditions. They've got their costs sorted out. And I think they're probably all relatively well poised to benefit from any recovery that does come through. So if there is any sense of improvement in things, both the company's performance and hopefully therefore their share prices could react really quite strongly. So still feels well set. How about next week? What's coming up data-wise?
It's mainly about inflation next week. So we got UK inflation on Wednesday, which is expected to show an increase from 2.6% annualized to 3.3%, which is directionally different to what the US reported on this week and significantly higher. Going to be interesting to see how that one plays out. And on Friday, we've got inflation from Japan, which is expected to be even higher still at 3.7%. But obviously, when you bear in mind that the Bank of Japan policy rates are currently less than half that figure, well, I don't know what they're going to do, but
Something's got to happen, surely.
One day.
Yeah.
But to put that in context, we had inflation data for Argentina for April today, which came in on an annualized basis at 47%, which might sound like a high figure, but it has been on a continual downward path from the 292% that it was recorded in April a year ago. So Mr. Milei is continuing to land the plane in Argentina and bring inflation down, and he's now floated the peso. He's moving towards full dollar convertibility. So far, so good, without collapsing the value of the peso again. Maybe he should take a trip to Tokyo and show them how to do it.
Help them manage their economy. Brilliant. Good. Well, an interesting week ahead. Thank you, Jeremy, as always, for your insight and thoughts on what's just happened this last week, and look forward to catching up this time next week.
Okay, look forward to it.
Talk to you then.
Brought to you by Progressive Equity.